So pleased to have Barry Flagg here once again for our second of several webinars on life insurance and life insurance related technology. Barry, welcome.
Thanks, Alan. Glad to be here.
Absolutely. Now, we have some upcoming webinars I just want to mention. Wednesday, March 4th for premium financing in 15 minutes. That's going to be very interesting. Thursday, March 5th, how to handle stressful matters in an ethical way. That's going to qualify for 1 hour of ethical credit for lawyers, and it's going to be a very, very practical approach to handling stress. Split dollar in 15 minutes, another Barry Flagg extravaganza. March 24th, myself, Ed Morrow, and Christopher DiNicolo, my partner, are going to talk about structuring joint exempt step-up trusts. And then March 31st, the final segment now scheduled for the insurance program, comparing the financial strength and risks associated with different life insurance carriers. So please feel free just to send me an email if you'd like to register for any or all of those. All of these are free except for the Joint Exempt Step-Up Trust, but if you're interested in the Joint Exempt Step-Up Trust, let us know and we'll try to find a way to get you on that. Don't forget May 7 and May 8. We're very excited about the Florida Bar Annual Wealth Protection Conference because we've added a new introductory level program Thursday, May 7. If you have associates who want to know the basics of asset protection, or if you want to refresh yourself, it's going to be a fantastic day for everybody. Then we're going to have everyone invited to the speaker dinner, Dutch treat. And then on Friday, May 8th, we're going to do our normal annual advanced creditor protection conference. Okay, Barry Flagg, he is not only a very, very knowledgeable financial advisor and chartered life underwriter, chartered financial consultant, graduated cum laude from the W. Paul Stillman School of Business at Seton Hall University. He's been on the CFP Board's Disciplinary and Ethics Commission, adjunct faculty member of the College of Financial Planner, Who's Who in Finance and Industry. He's been in the Financial Planning Association, the National Association of Insurance and Financial Advisors, the $1 Million Round Table, and unlike many, many people in his industry, he has a burning desire to help people understand how life insurance policies work and how you would determine what type of policy or what type of arrangement is suitable for a particular client or a particular situation. And that's where his inventing and development of the Verilic program comes in, which is so very interesting. So welcome, Barry.
Thanks, Alan.
Did I leave anything out?
No, I'm not sure you could fit anything else in the time we have.
Okay, very good. Well, Barry, I'm going to hand this over to you here.
Very good, very good. So we're here to talk about hybrid life insurance products, criticisms, reasons for popularity, and some new guidance to give us direction for reconciling perhaps the popularity with some of the criticisms. Of course, hybrid is something of a generic term. It can mean a number of different things. It is the combination of different elements into a single product. So that can mean a couple things, even as it relates to life insurance. What we're going to talk about here today is indexed universal life, which is a hybrid between universal life, which is in the name, universal life products which are required by regulation to invest in high-grade bonds and government-backed mortgages, predominantly as a practical matter, combined with some element of equity market performance. So that's the hybrid. It is clearly the most popular product today. Just in the fourth quarter of last year, it grew. The market share or sales grew by 42%, which elevated it to 36% of overall sales year over year. It is, by any measure, the fastest growing or product type in the insurance business. A big reason for its popularity is characterized in an ad from CNBC.
The IRS wants you to think these qualified plans are the best way to save for retirement. They give you a tax break when you contribute. Sounds good, right? Wrong. A qualified plan could be a tax disaster when you retire. With $17 trillion in debt, taxes are already going up. Imagine paying a top tax rate of over 90% like they did in the 1960s. There is a better way. It's an alternative the ultra-rich use that beats the pants off your IRA or 401k. It's been around for years. Your money grows tax-deferred, has no taxes in retirement, and no income taxes when you die. Plus, you can grow your money potential double digits with no risk of losing when the market crashes. If the market tanks like 2008, you lose nothing. Call Safe Money Millionaire now, 800-346-9797 to talk with a specialist and get a free copy of my Inc. magazine best-selling book to protect yourself from taxes and crashes. The next 37 callers get free shipping and handling, no credit card required. Call 800-346-9797, 1-800-346-9797, 1-800-346-9797.
So what could be wrong, Alan, with a product that the rich use, that has tax-deferred growth, no income taxes when you take it out, no income taxes when you die? It can grow with double-digit returns with no risk of loss. What could be wrong with a product like that? Interestingly, the Securities and Exchange Commission issued a rule in 2009 saying that these index products should be considered investments under their jurisdiction and therefore subject to their rules. And ironically, a number of insurance companies sued the SEC to block Rule 151A and also lobbied Iowa Senator Tom Harkin, who was on the Dodd-Frank Committee, and got inserted into the Dodd-Frank Act something called the Harkin Amendment, which makes indexed insurance products not investments, makes them only insurance products. So from a regulatory perspective, they're not hybrid products. From a regulatory perspective, they are only insurance products. They don't have an investment element as far as the Harkin Amendment is considered. If they were considered to have an investment element, then the ad you just heard would be illegal, would violate the rules that the SEC and the chief regulatory body of the financial services industry promulgate governing what can and cannot be said about investments in such a manner. So one of the questions, if not criticisms, is for a product that's being talked about like an investment and talked about as an alternative to other investments, but it doesn't have to follow the same rules and doesn't have the same oversight as other investments. That is one of the criticisms, that the public may be hearing something and unable to discern between apples and oranges. Another criticism or question is most of the marketing material talks about, as we just heard, double-digit returns. It talks about performance of the indexes like the S&P 500 or other indexes depending upon the product. But the index performance inside these index products do not include the total performance of the index. They exclude dividends from the performance of the index for reasons we'll talk about. But that can amount to 40%, depending upon the time period you measure, it's 40% or more of the total return. So if you think about the S&P 500 since 1926 producing an average return of around 10%, that means that 4% of that 10% was received in the form of dividends but would not be received in index products, which certainly has some impact on the ability to achieve double-digit or higher returns.
That is big.
It is big, and it is one of the more misunderstood elements of index products.
Because the policyholder never really gets that information or never really understands it.
That is correct on both counts. So while returns may be, if the policyholder doesn't understand that they're getting performance excluding dividends, then they're expecting a higher return than they're likely to get, or than they will get. And a number of studies have revealed that the costs in many of these index products are higher, as much as 45% higher, according to one study. And according to a Trust and Estates article, with some notable exceptions, the indexed universal life products are on average meaningfully higher in costs, but it's hard for the consumer or the policyholder to see the higher costs because they're commingled with high projected indexed rates in sales illustrations, which can mask these higher costs. So another criticism is the use of illustrations, which I will come back to, instead of maybe a more prudent alternative, which I will also talk about. Something else that's not been tested is these index products they've been around a while, but they're only recently as popular as they currently are. And so what will the impact of market volatility and rising interest rates do on the index crediting rates? And I'll come back to that, Alan, if I forget, try to remind me.
Sure.
There is an example we'll talk about toward the end that that I can talk about, the impact of market volatility and rising interest rates on the index crediting rates. And then lastly, I've already alluded to the use of illustrations, which we talked about in our last webinar, or at least the last webinar you and I did. The use of illustrations comparing one hypothetical to another are now questioned by multiple industry authorities, although that is a prevailing way that these products are marketed. And we'll talk about the reasons why they've now come into question. But before kind of getting down into the weeds, I want to stay at the proverbial 30,000 feet and talk about what is indexed universal life as it differs from other life insurance, or as it may be the same or different from other types of permanent life insurance or cash value life insurance. So indexed universal life insurance is a universal life insurance product at the risk of stating the obvious, and it works in all the same ways, exactly the same, except in the way policy interest is credited. So last week we talked about how a policyholder pays premiums into a universal life policy, and then from that premium is deducted premium loads and admin fees, and in some cases wrap fees and cost of insurance charges, and then what's left over goes into the cash value, and then that cash value is credited with an interest rate. In universal life, it's credited with an interest rate based on the performance of the general account, which, as I said earlier, must, as a practical matter, be invested by regulation in high-grade bonds and government-backed mortgages. The difference for IUL is that instead of that interest being credited back to the policyholder's account, so if we think just in the long term, the rate of return that's the historical rate of return for high-grade bonds and government-backed mortgages over the long term, it's certainly not what it is now, but over the long term, is in the area of 5%. So in a universal life policy, the policyholder would receive an interest credit of 5%. In an indexed policy, they don't get that interest. That interest is instead used to buy options on an index, and then the interest that they get credited back to their policy is dependent upon the performance of that index. But it's not actually invested in the index. It's an option, if you will, on the index. So how does that work? The policyholder pays a premium. The premiums and those cash values, just like universal life, are invested in high-grade bonds and government-backed mortgages, and then the interest from those bonds and mortgages are used to buy options on a variety of indexes, the most common of which is the S&P 500. And it's that indexed interest credited back to the policy cash value that is a function of two things. One, it's a function of the amount of the interest from that general account. If the insurance company is a good manager of bonds and mortgages, then they're going to generate more interest and they're going to have more money to buy options, which is commonly referred to as the options budget. The more money you have to buy options, the more likely you are to get a return on those options. And then the other aspect of it is the value of those indexes relative to the options. But one thing that's almost never illustrated in these hypothetical projections is these options on these indexes in some years will produce a very good return, and we'll talk about an example of that. But in some years, options can expire without any value at all. So if it was a universal life policy, as we talked about before, you'd get using the long-term rate of return for high-grade bonds and government-backed mortgages as an example, you'd get your 5%, and as interest rates went up, or as they are now down, you'd get less like we're getting now and more like you got in the 1980s. But with the indexed universal life, you'd either get some participation in this index or you get nothing at all in the investment management underneath. And so that's what's actually going on behind the scenes. Then what the insurance company then does is they translate that in ways that are not disclosed, which by not disclosed, I don't mean it's a good thing or a bad thing. It's just it's not disclosed. They translate that into a formula that is then credited to the policyholder's actual account. So when I said a minute ago that the indexed interest credited is a function of, that's the mechanics on the insurance company side. How they actually translate to the policyholder is a formula of based on a participation rate and a cap rate. So for instance, it is a relatively common product structure to say, okay, we're going to award 100% up to 10% of the S&P, sorry, 100% of S&P performance up to 10%. Could be up to 12%. It's been higher. It's been coming down for some of the reasons that I said I would come back to. The impact of interest rates and volatility on the crediting rate to the policyholder. So some percentage of participation up to some cap is a very common way that the insurance company calculates what actually gets to the policyholder, and then the policyholder can choose how to measure their participation. They can either, for the two most common are, they can either say that from the policy date until one year later or some number of years later, that's what we're going to measure. So let's say the S&P 500 went up 30% between January 1 and December 31 of a calendar year, and that happened to coincide with the policy year, and it was a point-to-point, then the rate of return you plugged into that formula would be 30%, so you get 100% of 30% capped at 10%, you get 10%. If the S&P was only up 5% over that period of time on the point-to-point measurement period that you're under, then you'd get 100% of the 5% not capped to 10%. And then the other somewhat less common measurement period is simply taking monthly snapshots and then averaging them over the time, still with a participation rate and a cap. Is that making sense, Alan?
Yes, it does. It's extremely difficult to understand, and I've never seen it explained in a way that somebody, even with an MBA, could understand it. It's so vague and complicated.
There is an awful lot going on. There's the insurance company calculates the way they generate return one way, then they translate it into a formula. And by the way, these formulas are generally subject to change. So they can, if their performance on their end, which we'll talk about an example of later, If their performance on their end is not what they're expecting, they can change the participation rate or the cap. Not always. Some of them will guarantee one or the other, but I've never seen both guaranteed. So they can change the game over time, and it is. I agree with you. It is very, very difficult to understand. If I'm invested in a universal life policy, I know what prevailing. I can get a sense for what prevailing interest rates are, and I can get a sense for, am I getting a fair crediting rate. If it's a variable life policy and I'm invested in a stock fund, well, I know what the stock market did, and I know what my fund did, and I can look up in a Morningstar report and see if I'm getting a fair return. With these index products, I agree with you. It is difficult, if not impossible, to reconcile whether or not you're getting a fair return. Very difficult. And as I already said, the insurance company has broad discretion in determining how to credit that gain in the index actually to the policy. So how do we've got a product that is growing in popularity, rapidly growing in popularity. It offers some very appealing characteristics, but there are some real questions or criticisms. So how do we reconcile those? Well, in the last few years, there's probably been more guidance relating to life insurance in general than in the prior 10 or 15 or 20. And so let's look at some of that guidance. One of which was in 1993, so this is actually prior to indexed universal life. In 1993, the National Association of Insurance Commissioners came together to publish model regulations for illustrations. And the goal was to ensure that illustrations do not mislead producers. Of course, you don't convene a committee meeting to solve a problem that didn't exist, so there was and I think still some effort by some insurance companies to win the proverbial beauty contest with the insurance illustration. Tweak the illustration to make it look as appealing as possible for competitive reasons. So in 1993, the National Association of Insurance Commissioners published these regs to help ensure that illustrations do not mislead purchasers, and they're in the midst of updating it right now. They tried to update it in 2014 to actually to address some of the things going on in these indexed universal life illustrations, where illustrations that apparently use the same crediting approach, but they illustrate different rates. So again, it looks like apples to apples, but it's actually apples to oranges, and so they're trying to tighten that down. But in the meantime, again, the only reason why they would be coming together to try to update these regulations is because there is potentially misleading information out in the marketplace in these illustrations the way they're being used. So and this is consistent with guidance from other organizations. For instance, the chief regulatory body of the financial services industry published a rule saying that it is inappropriate to compare life insurance policies one to the other using these hypothetical illustrations, and in fact issued a clarifying document saying that any comparison that omits costs and expenses, which too many of these illustrations that I see, and remember, I'm not seeing, but we here at Veralytic, we are receiving hundreds and hundreds of illustrations that our subscribers submit for the purpose of getting a measurement of costs and performance. So the number that we stand back from new subscribers or from non-subscribers that are considered not in good order, that do not include disclosure of costs and expenses, is more often than not, again, for new subscribers. So we see a lot of illustrations. They are not including costs and expenses. and yet FINRA says that an illustration that does not include costs and expenses, that omits costs and expenses, causes the communications to be misleading. Guidance also from the chief actuarial body of the life insurance industry says that the comparison of illustrations for to determine which product is quote unquote better is not just inappropriate, it's fundamentally inappropriate. And most recently, August 2012, the OCC published a handbook for unique and hard to value assets with a section dedicated to life insurance in which they caution their member banks that these policy illustrations are subject to a high degree of fluctuation. So using the illustration to compare it to another policy, to compare an indexed universal life policy to a universal life policy, or an indexed universal life policy to a variable life policy, or an indexed universal life policy to a retirement account, as we heard in the CNBC article, you're comparing things that are subject to a high degree of fluctuation, that are not reliable, and so we now have considerable guidance that says that that's not really a good idea. However, the good news is that we now have 44 states that have adopted the Uniform Prudent Investor Act, and the Uniform Prudent Investor Act provides guidance for insurance trusts. So it provides guidance for insurance. And I analogize this. I started my career in a pension investment advisory department about the time when ERISA was taking hold and Morningstar was taking off. I saw that even though ERISA only applied to qualified retirement plan assets, it had an impact on the entire investment business, the entire mutual fund and the entire investment business, because it was good guidance. And I think we have the same thing here with the Uniform Prudent Investor Act saying, instead of comparing illustrations, let's, at the risk of stating the obvious, let's examine the information that's likely to bear importantly on the value or the security of whatever the asset is, and it applies to life insurance, so it would certainly, and it applies to life insurance, so it also provides guidance for life insurance. We know from the Cochrane case that the premium in a life insurance policy is not the measure of cost, because there were no premiums in the Cochrane case. Instead, we know that the costs in the life insurance policy are what I said earlier, the premium loads, the administrative expenses, the wrap fees if there are any, and the cost of insurance charges. The more prudent thing to do than comparing one hypothetical to another would be examining what the actual costs are. And my interest in this subject matter, in addition to being raised in a fiduciary environment first or a prudent investor environment first, is we publish a ruler that allows practitioners to measure very, very quickly, in fact more quickly than comparing illustration, allows them to measure whether or not the cost inside any policy, whether an indexed universal life policy or a universal life policy or a whole life policy, whether it's a fair price. For instance, this is an excerpt from one of our reports that shows the average cost of insurance charge, the average expenses, and the average premium load for everything in our database, and then also shows the actual cost of insurance charges, the actual expenses, and the actual premium loads for a policy under evaluation. We know, because we have the database, that there is an 80% swing between good and bad pricing, which means that there's a 40% swing on the high side for worst available rates and terms, and there's a 40% swing on the low side for best available rates and terms. So in a matter of time, less than it took me to talk about it here, any attorney, CPA, trust officer, or insurance professional can know or prove to their clients that the policy they're recommending or policy that's in place is among best available rates and terms or not, in which case some more work may need to be done. And then returning to the Prudent Investor Act for the other big element that I think is a more prudent alternative to comparing illustrations, again at the risk of stating the obvious, is what is the rate of return that's reasonable to expect? And so I said I would come back to a real life example, and here it is. In kind of doing the reasonableness test for the expected rate of return on a indexed universal life policy, let's pretend for our reasonableness test that we had $1 million in cash value up here, and we said earlier that the interest rate that would be reasonable to expect over a long period of time, not now because we're in a low interest rate environment, but over a long period of time based on historical performance, could be 5% from a general account that, again, is required by regulation as a practical matter to be invested in high-grade bonds and government-backed mortgages. So that means if this was a universal life policy, we would be credited with $50,000 back to our cash value, and we'd have $1,050,000 in cash value. But in an indexed universal life policy, that $50,000 does not go back to the policyholder. It is used to buy options, again referred to kind of in the industry as the options budget. So if we have an illustration that's showing an 8% rate of return, now bear in mind 8% is not a double-digit rate of return, but it's showing an 8% rate of return, that would mean that in order for this illustration to work, those options would have to generate an $80,000 return or an $80,000 interest rate on the $50,000 investment in the options. So $50,000 in interest from the high-grade bonds and government-backed mortgages is invested into options. That 50 has to be turned into 80. Well, that $30,000 gain on a $50,000 investment is the equivalent of a 60% rate of return. Now, options are a very, very volatile asset type, so I'm not saying it's not conceivable to get a 60% rate of return out of an option, out of an option play, but I can't find a source of data that would suggest that a 60% rate of return is possible every year, year in, year out, for as long as the policyholder holds the policy, which is 20, 30, 40, 50 years. That would seem to be questionable and would warrant some further investigation with the broker or with the insurance company. Again, let alone what was promoted in the CNBC advertisement, a double-digit return. You can only imagine what the rate of return of the options would have to be in order to actually deliver a double-digit rate of return to the policyholder. Possibly a more reasonable enhancement from participation in the equities. I think it's possible to get a 6% rate of return. That would mean that the options would have to produce a $60,000 credit back to the policy, which would be a $10,000 gain on the investment of the $50,000 in interest from the general account. That would be more like a 20%. And I don't know. Again, I've been looking for, and I've not yet found a source of data that would say whether 20% is reasonable or not. It's certainly more reasonable than 60%. I certainly have heard of options returning more than 20%, but then you got to counterbalance that with the fact that some years those options are going to expire without any value at all, and when they expire without any value at all, then if they expire without any value at all half the time, then you'd have to get back to a 40% rate of return on your options. So again, there's an awful lot that goes on behind the scenes in these products. So some investigation as to those things that bear importantly on the value and the security of the performance of this thing is really warranted, as complex as it is, examining the costs and really having some conversation about the reasonableness of the rate of return. A couple of other red flags, and then we're running out of time, is something that I've heard referred to as hyperfunding. it is, and we don't have time to really get into it here, but it is effectively margining cash values. So it's paying premiums, but then it's also borrowing from the cash values to pay even more premiums. So it's margining the cash values without increasing what's coming out of the pocket, but it effectively, just like in a margin stock account, it doubles the potential for rate of return. And it makes the illustrations look, because it doubles the potential for the rate of return, it looks awful good. However, in those years when the options expire without any value at all, it also doubles the risk that things are not going to work out as planned. And that's not typically, in fact, I've never seen that reflected in the illustration. So that is and I'm not saying, again, hyperfunding is a bad thing. Someone who is aggressive, someone who might margin their stock account, hyperfunding might be suitable for, but you got to go through the risk profile with the client so they understand that with this illustration that looks very, very attractive comes risk that's not being shown in the illustration. Similarly, indexed loans assumes the borrowing of cash values. So ordinarily, if you borrow your cash values, those cash values are no longer invested by the insurance company, and so they generally do not get a interest rate back to the policy, to the cash values. If I take money out of my policy, the insurance company generally is not going to credit interest. But under some theories or some insurance companies' interpretation of their contractual language, they are proposing, or they're suggesting that they will continue to credit the interest from the index even though the money is no longer in the policy. Even though the money is not in the policy, to generate the interest that can be used to then buy the options, the illustration is suggesting they will nonetheless continue to credit the indexed interest rate, which again, I don't know that can't happen. It sounds aggressive to me, but it's a red flag that is that we don't have time to go deeper into here, but would be one that would warrant further consideration and investigation before I would feel comfortable allocating any funds to it. A similar approach or a similar dynamic, but instead of using policy loans, using third-party financing to pay for premiums. Again, that just like all borrowing increases the potential for leverage and return, it also increases the risk of loss. And we'll talk more about that in the webinar Alan mentioned on March 17th. And then lastly, kind of an easy question to ask, might should have put this one first. An easy question to ask is, are the participation rates and the cap rates the same for new products as they are for the in-force block? Or said the other way, are they the same for the in-force block as they are for new products? You know, you've heard advertisement on TV where banks advertise one CD to get you in the door and they renew at another rate, the proverbial bait and switch. Same thing here, although it's worse, because if I'm in a bank and my CD matures, I can move my CD to another bank. Most of these index products have a surrender charge or an early termination fee that can last 5 years minimum, 10 years more commonly, as much as 20 years. So getting out can be very costly, and if the insurance company decides to change the crediting rate or excuse me, the cap rate or the participation rate on an in-force policy, you don't have as many remedies available. So I think it would just be kind of the good faith of it would demonstrate some of the good faith of the insurance company if they're using the same participation rate and cap rate for attracting new business as they are renewing in-force policies. So wrapping up, there are a good many questions about these IUL products. I do not mean to be to leave the audience with a negative feeling toward them. I think that they are can be absolutely appropriate in the right circumstances. They do offer the possibility of enhanced returns, and we're in a low interest rate environment, so getting an enhanced return is certainly something that can be attractive. They absolutely positively limit the risk. It wasn't but just 5 or 6, 7 years ago that if you had invested in the S&P 500, you would have lost 50% of your value, and these products will protect you from that. So for somebody who wants an enhancement in their return in this low interest rate environment, but who doesn't want to actually be in a variable policy where we could actually allocate to inversely correlated asset classes, wants downside protection, this product I think is worthy of consideration, again with a number of questions that really should be asked in the due diligence process. But whatever is done, comparing these hypothetical illustrations, is not a prudent way of doing your due diligence. Not because I say so, not because we publish research that's an alternative, but because we now have financial, insurance, and banking industry authorities to say it's not a good idea. And I really don't necessarily make any apologies for publishing research that supports what prudent investor principles and prudent investor laws say, and that is measure the cost representations from the carrier, measure the rate of return, or the performance expectations for investing assets underlying cash values. That to me, again, starting in the fiduciary business, spending most of my life working in a fiduciary environment in both investing and insurance, that seems to be a more prudent way of approaching the selection of any product, including indexed universal life.
Barry, could you mention the names, if you would, of 1 or 2 carriers that you think do a relatively good job of disclosing costs and explaining how these products work in their illustrations or literature? Because everything I've seen has been very ambiguous, very vague, and even when we've asked carriers to show us, well, if that index does this, what will your product do? It's been difficult to get what I would consider to be a straight answer.
Yeah. Well, I know of none that will, if you can think back to the slide where we were talking about, here's how the carrier, here's how the insurance company calculates how they generate return, and then here's the formulas that they use to credit that to the policyholder. I know of no one who actually discloses that, not a single insurance company. There are insurance companies that do a good job of disclosing expenses, and in fact most of them, well, no, not most, all of them will produce a disclosure of expenses because it's actually part of the National Association of Insurance Commissioner Model Illustration Act. So they have to produce expenses. Some of them are more forthright in doing it than others. The carriers, there are 10,000 pricing combinations, permutations for every single product, from age to gender to risk class to smoker status to face amount. You do all the factorial math on those combinations and permutations. There are 10,000 pricing combinations and permutations. It'd be unfair to single out any carrier, good or bad, that does a good or bad job of disclosure, or that has good pricing or bad pricing, or that has good performance or bad performance. But I would absolutely, positively urge anybody listening to the call to ask for the detailed expense pages. We talked about them at length in last week's or in the previous webinar, which I believe is recorded, right, Alan? So they can listen to that if they want to know what detailed expense pages are. They can go look at that.
Right.
And there are carriers that if you ask some of the questions that I've suggested here, there are some carriers that are genuine in their interest to try to answer that and give the policyholder comfort. And there are some that I've not found that do. And so that to me would be, if I had a hard time getting an answer to a performance question, then that would make me nervous. That would be one of the red flags that I should have added to the slide.
Right, right. Okay, yeah, because I've been extremely disappointed in looking at illustrations and then looking at and seeing what the index would have done comparative to the illustration, and such a huge gap. And then the lack of knowledge or lack of willingness to provide knowledge by the salespeople. I just have found this to be a very thorny area. I think some of the carriers just won't offer this product, right? And they've been writing letters to the commissioners complaining about the carriers
Correct.
that do offer these products, such as Northwestern, I think, and Guardian
Correct.
don't even offer these. So I think there's going to be a lot of unhappy clients up the road, and a lot of lawsuits and arbitrations, because as you say, they're not showing the expenses. So
Well,
it's an interesting area.
So one of the things I should have, I toyed with putting into the slideshow is a article from a monthly, I think it's a monthly publication from the National Association of Insurance Life Brokerage Agencies. So this is a life insurance industry publication. And the quote from the industry publication says, many life insurance consultants and ethical experts agree that the industry's current illustrations of indexed universal life performance are not only misleading, they are downright dangerous. So I could not agree with you more that for those who are not asking the right due diligence questions up front, they're more likely to be disappointed in performance, and given the movement of the entire insurance industry more toward prudent investor principles, the lack of disclosure, I think, is going to come back and bite somebody. I don't necessarily know who, but it's going to come back and bite somebody.
Yeah, the industry as well.
Yep.
Okay, well, Barry, have a fantastic day, and may the rest of your time be billable. Thanks again, Barry.
You're welcome. Thank you, Alan.
Take care.
Bye-bye.